What do you think about just the first half of the year, the fact that it was mega cap tech, the AI trade, and so much concentration power in the market? Is that a reason for concern in the second half of the year?
Look, we've had good news. Inflation's coming down, job market's okay, and the economy looks all right for a soft landing. But this is a lot of concentration. PEs are high, so there's concerns there. But I think the confusion in many investors' minds is maybe I should have really conservative equities or buffer strategies of things of that nature. But I think that neglects the possibility that asset allocation can work again. Bonds aren't broken.
All right, so second half, but we got to start the second half with the first day of the second half. How do you see today shaping up? What's your WEX word of the day?
My word of the day is daily. And the key here is daily covered call options. Folks looking for defensive strategies in the past, in recent past, have looked to monthly covered call strategies that have historically delivered about 1/3 of the return of the equity markets. And I think that's part of the reason for that is that bonds have been broken. But with a 4.5% yield on the 10-year, there's an opportunity for bonds to bail us out if we're wrong and if the economy's weak. So a better plan for looking for equity income is a daily covered call strategy. When you write those calls every single day, you can generate that same equity income, but actually fully participate in the equity market.
So it sounds like you're in a bit of a defensive mode, even though the markets are very strong. I also want to point out something else. B of A out with a great note. Second half of election year for basically the last century, 83% higher. I'm sorry, higher 83% of the time, with an average gain or median gain, I should say, of 7%. Don't the historics tell us that we're on par or on pace, I should say, for a strong second half of the year? Why would you be so defensive?
I don't think it's a question of defensive. I think it's a question of taking advantage of the asset allocation opportunity, not only on the bond front, because that's your diversification if something goes wrong, but also small and mid-cap stocks, which are trading at 50 and 40 cents on the dollar. If we go back to 2000, mid and small cap stocks only shrank about half as much as large cap stocks, and in fact, bonds went up 30% as the tech wreck was happening at the beginning of the century.
I want to save time for your pick, but very quickly, BTIG out with a note basically saying if small caps are going to work, we think they have to start soon, or they become a canary in the coal mine rather than a rotation opportunity. You've been very vocal about the opportunity in small caps. Aren't we getting into a concerning level? I mean, the Russell only up 1%. Isn't that a sign that maybe the economic slowdown might be deeper than some people may be fearing?
I think if you're looking to the small cap space, you have to look for quality. It's absolutely true that volatile small caps, where 2/3 of them don't make any money, is a challenge. But small cap stocks that are generating cash flow are a real opportunity that's been left behind by the Mag 7.
Got to give us the elevator pitch on your pick. It's ticker ISPY. Why is that a good buy today?
So ISPY is the ProShares S&P 500 High Income ETF, and it follows the S&P 500 Daily Covered Call Index, which I mentioned. This is a new innovation. You've heard a lot about daily options, zero DTE, but there's an opportunity to use them conservatively. And if you execute a covered call strategy every day instead of once a month, you're up to bat the next morning. You're not called away for the month and leaving behind all the equity upside. And that's a real innovation that can be of great value for folks needing equity income. It's not conservative per se. It's allowing your equities to truly behave like equities.